What's up, Japan Market Samurai? Broadcasting fresh updates straight from Japan. But hold up, you're not still thinking Japan? Isn't that just a weak yen play? Or worse, China's risky, but I'll just sit on my hands until the fog clears. Seriously? You do realize that your smarter competitors are already rotating capital into Japan, quietly, strategically, and months ahead of the crowd. Are you just going to wait until headlines say global funds pile into Tokyo to make a move? By then, the train's already left. Look, this isn't about being some macro wizard or reading Japanese. You don't need secret insider access or a Bloomberg terminal to get this right. What you need is a framework, a repeatable way to identify markets that absorb geopolitical shocks instead of magnifying them. And Japan offers that framework. It's not a hunch, it's not hype, it's logic, policy, and profit aligned. And yes, you can learn how to use it. Picture this. You're holding positions in sectors that don't crash when China announces an export ban. You've got exposure to a developed economy that manufactures locally, uses fewer critical minerals, and rewards shareholders. Meanwhile, your friends are sweating over rare earth volatility, you're sitting on high efficiency, low dependency gains. Your portfolio is stable, your thesis is clear, and you're early. Feels different, right? That's what being resource smart gets you. Let's be honest, you're tired of watching semi-targeted stocks tank every time a new regulation hits. You felt the sting of black swan risks that everyone should have seen coming. You're right to feel uneasy, but here's the kicker. If you think staying out is safer, that's the real trap. Because while you wait, others are building positions in countries that don't panic at every headline. And if you still believe Japan is a dying economy, then sorry, but you're clinging to a 1980s narrative in a 2025 market. Let go, or get left behind. But Japan's just a short-term play, right? Wrong. But I don't understand Japanese markets. You don't have to. That's what this channel is for. But it's too late. Actually, it's still early. The global capital rotation is quiet, not over. Excuses are comfortable, but they won't grow your money. Let's retire them today. Look, I started by just tracking one thing. Which markets actually reward efficiency, not just scale. And every breadcrumb led back to Japan. Not because it's flashy, but because it's quietly engineered for resilience. No one handed me this playbook. I built it, and now I'm sharing it with you. If I can see this, so can you. And once you do, you'll never look at Asia the same again.
This isn't a top 10 stocks to buy fluff video. This is built from first-party data, real trade flows, actual policy changes. No filler, no fear-mongering, just facts and frameworks you can use. So if you're serious about building a smarter, shock-resistant portfolio, hit that subscribe button right now and make sure you stick around, because what I'm about to break down might just be the clearest investment edge in Asia today. Step 1. Japan absorbs geopolitical risk better than China. Conclusion. Japan is structurally built to absorb geopolitical shocks. Let's start with the bottom line. In a world where supply chains get weaponized and sea routes can be choked overnight, Japan is structurally the safest country in Asia for long-term capital. Not because it's immune to risk, but because it's engineered to absorb it. If you're trying to future-proof your portfolio, the first question is not where's the growth, it's who can keep running when the world breaks. And right now, Japan has the most underappreciated answer to that question. Reason. Energy, logistics, and supply routes make or break your portfolio. Here's the truth that doesn't get said enough. Every dollar you invest in Asia carries logistical and energy risk, and nowhere is this more obvious than in China's energy situation. Most of China's oil flows through the Malacca Strait, a narrow, crowded sea lane that's one diplomatic crisis away from blockade. That's the infamous Malacca Dilemma. To work around it, China has built land pipelines through Russia and Myanmar. But even then, it can't fully de-risk. And investors know this. That's why when tension rises in the South China Sea or Middle East, Chinese equities get punished immediately. Now contrast that with Japan. Yes, it imports 90% of its oil, mainly from the Middle East. But here's the key. Japan doesn't try to outrun risk, it out-engineers it. Since the 1970s oil shocks, Japan has embedded energy efficiency into its entire economy, from factory lines to home appliances to urban transit. Result, Japan needs less fuel per unit of GDP than almost any other country. That makes it naturally resilient. Example. Efficiency is Japan's true energy reserve. Think about what happens when energy prices spike or shipments get delayed. Most countries panic, industries stall, margins collapse. But in Japan, high-efficiency systems kick in. This isn't theory, it's proven. Take the Top Runner program, a policy where the most energy-efficient product sets the standard for the entire industry. Automakers like Toyota design hybrid systems, not as a luxury, but as a national energy strategy. Industrial robotics, automation, and process control systems were designed to squeeze output from minimal input. This isn't greenwashing, it's economic survival. And when global markets get hit by oil spikes or geopolitical supply squeezes, Japanese firms take smaller hits and recover faster. That's not luck, that's design. Wrap up. Japan isn't safer because it avoids risk, it absorbs it.
Let's be crystal clear. Japan still imports most of its energy, but it's the only country in Asia that has spent decades engineering around that dependency, and that shows up in how Japanese markets behave during crises. Less volatility, faster recoveries, stronger policy response. If you're looking at Asia and wondering where to place capital for the long haul, the smart bet isn't the biggest, flashiest story. It's the country that already designed its economy around the next shock, and that's Japan. Step 2. Japan uses fewer critical minerals and recycles more. Conclusion. Japan is less exposed to the weaponization of critical minerals. In a world where key materials are being turned into bargaining chips, Japan stands out for a simple reason. It doesn't just use fewer critical minerals, it needs fewer. When nations like China control the flow of rare earths, graphite, gallium, and germanium, the question becomes, which country can keep producing even when the tap is turned off? Japan has quietly built that capability for over a decade. While others depend on volume, Japan depends on precision, substitution, and reuse.
Reason? Because Japan learned the hard way and adapted. Let's go back to the early 2010s. China cut off rare earth exports in retaliation against Japan. It was a geopolitical gut punch and a wake-up call. But Japan didn't retaliate, it didn't whine, it rebuilt. And fast. Government, industry, and academia came together and made rare earth independence a national mission. They didn't wait for a crisis to pass, they engineered around it. What came out of that? Magnetic materials with reduced or zero reliance on dysprosium. Smarter motor designs that need fewer rare earths to generate the same torque. Recycling systems that recover materials from used products. Japan realized, if you can't outmine China, you out-innovate it. That's not a slogan, that's economic strategy.
Examples. Toyota's magnets and Japan's recycling ecosystem. Let's get specific. Toyota developed motors that use no heavy rare earths, a game changer in EV manufacturing. Their solution? A high-performance magnet that drastically cuts neodymium and eliminates dysprosium, which are heavily China-dependent. It didn't stop there. Companies like Hitachi Metals and Daido Steel developed magnets with alternative compositions, further reducing vulnerability. Meanwhile, Japan's recycling ecosystem quietly grew. Urban mining programs extract metals from e-waste. Runner, battery-to-battery recycling closes the loop on lithium and cobalt. National research centers push continuous material innovation. This means when China clamps down on exports, Japanese supply chains bend but don't break. They've been stress tested. And that resilience translates into less volatility for investors. Wrap up. Japan's resource strategy is use less, reuse more, innovate always. Let's call it what it is. Japan isn't playing the volume game, it's playing the efficiency game. While others chase access to minerals, Japan asks, how can we get the same output with less input? That mindset builds companies that are leaner, more adaptive, and less exposed to commodity swings. And when global headlines scream about export bans and supply shocks, Japanese manufacturers stay the course, and your portfolio breathes easy. This is not luck. It's the compounding effect of 2 decades of engineering discipline. If you're building a long-term position in Asia, this is the kind of material resilience you want under the hood. Step 3. Capital discipline and shareholder returns. Japan's quiet revolution. Japan's corporate governance shift has unlocked a new investment era. For decades, Japan was known for low returns, hoarded cash, and companies run like family clubs. That era is over. Since 2023, Japan's stock exchange has forced public companies to justify their valuations, and it's changing everything. Buybacks, dividends, and transparency are no longer rare events. They're becoming the cultural norm. This shift is the backbone of Japan's market revival, and global investors are only just waking up to it. If you still think Japan is a value trap, you're living in the past. Reason: the Tokyo Stock Exchange called out underperformance publicly. Here's what changed. In 2023, the Tokyo Stock Exchange 2SE told companies trading below book value to explain why their share price was so low or fix it. That's like a national wake-up call. For decades, management teams could hide behind tradition, saying, we prioritize stability. Now, they're being told, prioritize returns. This single policy flipped the narrative from defensive to proactive. And because of it, Japanese companies began competing for investor trust for the first time in years. We're not talking about slogans, we're talking about measurable outcomes, ROE improvement, better capital allocation, and steady buybacks. The mindset changed from avoid risk to earn your multiple. Example: buyback culture and valuation re-rating in motion. Take a look at what's actually happening on the ground. In 2024 and 2025, Japan hit record levels of stock buybacks, the highest in Asia, rivaling even South Korea and Taiwan. Names like Toyota, Sony, Mitsubishi, and Hitachi aren't just raising dividends, they're repurchasing shares consistently. And here's the key part: it's not just blue chips. Mid-sized manufacturers, trading firms, and even banks are doing it. Why? Because being on the TSE's underperformers list became a public embarrassment. No CEO wants to be labeled as capital inefficient. As a result, investor relations departments, once symbolic, are now strategic weapons. The shift is visible in foreign fund flows too. Reuters and Bloomberg data show continuous net inflows into Japan-focused ETFs and institutional portfolios. Investors are voting with their capital, and management is finally listening. Wrap up. Governance plus returns, Japan's re-rating engine. So what does this mean for you? It means Japan's market isn't running on hype or currency. It's running on policy-driven capital discipline. That's sustainable. Corporate Japan is now positioned as a developed market value with emerging market upside. Governance reform is the fuse. Shareholder returns are the flame. And together, they're powering one of the most underpriced structural shifts in global equity. When investors talk about the Japan trade, this is what they're actually describing. An economy finally rewarding shareholders. Not once, not temporarily, but systematically. Step 4. Japan is regaining its role as Asia's industrial anchor. Conclusion. Manufacturing isn't leaving Asia, it's coming back to Japan. While the headlines scream about de-risking from China, few are noticing where the risk capital is actually going. And no, it's not Vietnam, it's not India, it's Japan. Global manufacturers aren't just hedging geopolitics, they're rebuilding physical plants, talent pipelines, and supplier networks inside Japan. Because when you need high-trust, low-chaos industrial capacity in Asia, there's only one place left to build, and that's Japan. Reason. Geopolitical risk has made reliability the new alpha. Let's get real. COVID, trade wars, and Ukraine changed the calculus for supply chains. Efficiency is no longer just about cost, it's about survivability. China has scale, yes, but it comes with censorship, sudden regulations, and rising political noise. India has ambition, but lacks the infrastructure and regulatory maturity. Southeast Asia is fragmented and easily disrupted. Meanwhile, Japan offers political and legal stability, raw-nuts infrastructure, world-class engineering, tight supplier ecosystems. When the world gets uncertain, capital defaults to certainty. And Japan, after decades of being overlooked, suddenly fits the brief perfectly. Example, TSMC, Kumamoto and Japan's industrial rebound. You want proof? Let's talk about TSMC, Kumamoto. This isn't a rumor, it's already operational. The world's leading foundry chose Japan to expand its global footprint. Why? Reliable energy, government support, strong local suppliers, skilled workforce. And it doesn't stop there. Rapidos, Japan's national project to build advanced logic semiconductors, is moving forward with backing from Sony, Toyota, and the Japanese government. This isn't just industrial nostalgia, it's next-generation capacity. And the impact flows far beyond the fabs. Ripple on the multiplier effect. Equipment makers, materials suppliers, cleanroom tech firms, all benefit from the multiplier effect. This is what economists call industrial gravity. Once it shifts, it doesn't shift back quickly. Wrap up. Japan is no longer just exporting parts, it's building the future. Let's zoom out. For years, Japan was seen as a place of legacy tech and shrinking influence. But today, it's becoming a critical node in the next supply chain map. One that prioritizes resilience over raw scale. And capital is responding. Not with hype, but with factories. Not with speculation, but with hiring. If you want long-term exposure to Asia without betting on chaos, Japan is no longer the old economy. It's the smart core. It's not just manufacturing again, it's anchoring the rebuild. And for investors who see the map early, that's a structural edge you can't afford to ignore. Ending. If you've watched this far, take a moment to appreciate what that means. You're not chasing hype. You're not just scanning headlines. You're doing the real work, building a worldview that survives volatility. And in doing so, you're already ahead of 90% of investors who are still reacting, not preparing. This video wasn't about saying Japan is perfect. It was about showing you why, in a world full of noise, Japan offers a rare signal. Structural efficiency, real governance, manufacturing gravity. That's what capital respects. And now you know how to spot it. The question is, what will you do with that knowledge? Let's recap the core framework you just learned. Step 1. Japan absorbs energy and geopolitical shocks through decades of engineering and policy design. Runner-D Step 2. It uses fewer critical minerals and leads in recycling, reducing exposure to supply chain risk. Runner-D Step 3. Governance reforms and capital discipline are turning Japan into a shareholder-friendly market. Runner-D Step 4. Global manufacturers are anchoring in Japan, rebuilding trust in its industrial base. This is not a bet on sentiment, it's a bet on structure. And as always, structure outlasts sentiment. If this resonated with you, if even one idea helped to reframe your thinking, like the video and subscribe to the channel. Japan Market Samurai isn't built on trends. It's built on original analysis, primary data, and frameworks that hold up when the market shakes. Most people will watch this once and move on. But the ones who grow are the ones who revisit, reflect, and apply. So be part of the minority. Rewatch, share, build conviction. And when you're ready for the next level, there's more content on this channel waiting for you. I'll leave you with one idea. Buying resource-rich countries is beginner level. But buying the country that thrives when resources get weaponized? That's advanced. And right now, Japan is that country. This is Japan Market Samurai. Thanks for watching. I'll see you in the next video.